glad you're back with us on Wealth by Design. Brad Johansson, Tom Elder, president of Retirement Wealth Design. Good to be back with you, my friend.
Oh, I love being here on studio with you. This is a great day.
This is good. It's all about education and trying to help you figure out this whole retirement thing that nobody ever told you about, right? Here are some of the things that you've been told. Taxes. Don't worry about that. You're going to make less money in retirement, so you're not going to have to worry about taxes. So do we get a bunch of myths on all of these things where people say, don't worry about this, which makes us fail to plan for things that aren't going to necessarily be the way that everybody told us it was going to be?
I think so, and I don't think I think it's a caveat of where things started. Like 401ks were invented in 1978.
Yeah.
And so because they were invented at that time, we're no longer in that time. So some of the language that came out when 401ks launched,
fair enough,
it's not the same as it is today.
Okay, let's go into these two terms. Tax prep, tax planning. Tax prep is kind of what you do as you get ready for the middle of April. We hate tax prep because we want to pay the least amount of taxes. Same thing, we want to pay the least amount of taxes in tax planning, but we fail to do that a lot, especially heading into retirement. Give me the definition between the two, why it's so significant, and why it's so much a part of what you do every day with your clients.
I'll define it as I see it. So as I see it, tax preparation is more about what happened last year, right? It's looking backwards at the previous year. Like, I have a fantastic CPA myself, and what she helps me do is she helps me account for what we did this past year from a tax perspective. Now, what we do at Retirement Wealth Design is we look forward. We look forward for the next 5, 10, 15 years and see, can we start to reposition ourselves so that way we can save money as the taxes keep rolling in throughout retirement. So I'd say tax planning or tax strategy is more about forward looking, and tax preparation is more about backwards looking.
So if it is forward looking, and I think that's what you do most brilliantly, I'm going to say, because this is what you do individually with each person. So when we say, let's put together a tax plan, it's not going to necessarily look the same for everybody. Why is that so significant? And if we're planning that you get a greater runway to start planning for somebody years and years before this is going to happen and affect them negatively?
Yeah, it looks different for every single situation because there's so many factors that come into play for your individual tax plan. And what I mean by that is there's different tax rates for every type of account that you have. There's different tax rates for the different income streams, whether it be Social Security. Everybody's Social Security payment's going to look a little bit differently. How that interplays with your different types of taxable accounts, whether they're taxable, tax deferred, tax free, right? It just depends on the situation. And so what we really need to do is start from square one and get an income plan together to see where we're predicting the taxes to go for you individually. And then at that point, we can start to create a tax strategy to save more money for you, to keep more of your own money in your own pocket. Because at the end of the day, that's the whole purpose of retirement planning. How can you keep more money, spend more money, or leave a bigger inheritance for those that you love?
You're trying to make it easy for everybody, which is why I want to use what Tom has now put together. This is retirementtaxtool.com. You can scan the QR code. Scan the QR code right here. I'm going to leave it up for a second because the idea is, man, I've done what they told me to do. As Tom said, this whole thing of the 401k, I'm putting my money away tax deferred, started in 1978 when most of the pensions went away. You start saving for yourself. And it's a great idea. I mean, the tax brackets were much different in 1978. Well, now we've changed, but the money has still yet to be taxed. Put your amount in here. This is so user-friendly. Tom's put this together as a calculator. How much have I put in these 401ks, 457s, 403bs, some of the other accounts that we've got?
TSPs
that we've got as well. Put those in. And very quickly, we can calculate what Uncle Sam wants now, what he wants at RMD age, what he wants when you pass it down to the next generation. I apologize. You can't unsee this number because Uncle Sam's coming after it in a big way. On the other side, what are the strategies that we can use to, as Tom says, keep that money in your pocket? Please do yourself a favor and scan this QR code as we're talking about it. So I lead into that. Uncle Sam wants later. This is part of also a legacy plan. And you say, well, I don't really have a legacy. Well, if you have something and you want to leave it, there is tax planning that needs to be made for down the road, maybe when you're not even here.
Yeah, gosh, you did a great job explaining that, because at the end of the day, tax planning is about timing. And it's about timing and it's about planning. One of the things that really starts to bother me is when I just had somebody come in the other day, Brad, that they'd been with their advisor for over 10 years. They are now recently retired, and they came in for a second opinion. And what they wanted a second opinion on was taxes. And the reason they wanted this is they went to their advisor, who they'd been with for a long time, and asked about tax planning. And the advisor sent them to their CPA, which then didn't go very far. And so instead, what I did is we started to put this tax plan together. And what we found when we started to put the information in was that this individual was going to get crushed by their required minimum distributions when they turned 75. And what I mean by that is between now and then, they were going to be spending a very small portion of their 401k compared to what they could be. And they didn't really want any more. They were comfortable with that lifestyle that we were anticipating. And what our model showed was that come 75, they were going to have so much money coming in that it was actually going to jump them up 2 tax brackets, meaning that they were going to have to pay 12% more taxes every single year throughout the rest of their retirement than they really needed to. And for that reason, we started to put together a plan that we'd do Roth conversions every single year. And with these Roth conversions, it started to move money out of their IRA account into their Roth account, which now the Roth no longer needs those required distributions. And at the end of the day, it allowed them to keep more of their money tax-free. It allowed their money to now grow tax-free, and they're going to be able to leave a much larger legacy behind.
And that's where we want our money, is in the taxed never account. And understanding where our money is in taxed always, taxed sometimes, taxed never. Is it difficult for us to understand? And I think this is what you do all the time, is say, here's what you have, here's where it is, here's where we'd like it to get. Do people really understand where their money's sitting most of the time?
I think that people generally have accounts multiple places. And those accounts can be different, treated differently based off the tax situation. And so not always understanding what the implications are is very common, because it can get really confusing, to be quite honest. Even from a financial advisor perspective, sometimes financial advisors can get a little bit confused, or if we don't have a clear picture of how it's all going to interact together, we can get surprised by taxes down the road. And so what we have to do is we start from scratch, and from an understanding perspective, what I like to do, what I believe in, is that if I can't write it out with a crayon on a napkin that easily explains it, you probably shouldn't be doing it. And so we try to keep things very simple, very straightforward. If we do this, this is the outcome. If we do that, that is the outcome. Which would you prefer? And that way it makes the decision-making process very easy. And I do all of the math, I do all of the calculations, and just give the very simple output of what the math tells us.
This is why I want you to scan the QR code that's on your screen, retirementtaxtool.com. Remember this, keep this in your head, retirementtaxtool.com. Scan the QR code. For a lot of you, it feels like talking to a wealth advisor is hieroglyphics. I simply can't understand what you're talking about. Tom's telling you, if I can't write it on a crayon, on a napkin, for you to understand, we're making it too complicated. And don't you want to simplify retirement in the way that you want it? retirementtaxtool.com. Once you go there, and again, I apologize, you can't unsee the number, but you'll need another number. You'll want to make the phone call to 833-348-4813 so that you can put together a complimentary written financial plan. I already have an advisor. Well, you've probably had an advisor who's helped you up the mountain on accumulation. This is a specialist that's needed now to get down the mountain and understand I need to make sure my money's going to last until my last breath. You make the call. Maybe it's just time for a second opinion. 833-348-4813. You know where all your money is? Do you know what the tax implications are? How about a little help? We'll be right back.
For me, my ideal client looks like somebody that has worked hard their entire lives, has generally lived below their means, so they've been able to save some money, and now they just want to figure out how can they live off of what they've saved and live comfortably off what they saved. I also tend to sway towards somebody that is a conservative investor. What the math shows is that losses can hurt you more than gains help you. And so I like to work with conservative investors that don't want to have to worry about which way the market is turning today. They instead want to know which way is their grandkid turning today, right? Where is their next vacation going to take them to? Or where is their next charitable event going to be? And so my ideal client just wants to focus on the important things in life, knowing that they have confidence in their financial plan.
So glad you are with us on Wealth by Design. Brad Johansson, Tom Elder with Retirement Wealth Design. We're talking taxes. We're going to be talking taxes a lot because it's probably your greatest obstacle in retirement. How do we get over this hurdle? How do we figure this whole thing out? Part of it is the retirement tax tool. It's a calculator from all the money that you put away tax deferred that Uncle Sam still wants a piece of it. You say, man, this is my number. This will show you it's not your number because it's not all yours. You've got a partner who's not very friendly. Your partner wants it back whenever they want it back. You've got to make sure that you have a plan for it. So we talk about taxable, tax deferred, tax free as we move into. Explain where we are in tax history. You said, 1978, this whole thing changed, and all of these brackets changed. We're actually in, and it never feels it, we're actually in an advantageous time tax-wise. Why?
Well, I think it doesn't feel that way because, think about all the taxes that we have to pay. We have to pay sales tax, we have to pay property taxes, real estate taxes, income taxes, right? Everything feels taxed. Your Social Security is taxed, right? And so it feels almost overwhelming, and it feels like taxes are through the roof. And at this stage, this is the right time to start tax planning for your retirement. And whether you have done in the past or you're kicking yourself saying, I should have started this sooner, that's fine. Start today. Today is better than tomorrow, right? And so the first thing you got to do is get accounting for where we're at. And where we're at is actually one of the places that, historically speaking, is a pretty good spot to be. So taxes really shot up in the 1940s with World War II. And when taxes went up, it was to match the U.S. national debt. And then after the war ended, the U.S. national debt started to come down and taxes followed in suit. And it was interesting to see because we watched the U.S. national deficit come down significantly all the way up until around 1980, right? And again, 401ks were launched in 1978. And so it was this kind of perfect storm for where we're at today of taxes had been coming down, U.S. national debt had been coming down, and then 401ks were launched. And with 401ks, they said, you'll pay lower taxes in retirement, right? Invest in the stock market. The stock market's going to get significant growth. Save pre-tax now, and then don't worry about it until later. Problem is that our U.S. national debt has continued to go up now since the 80s versus taxes have stayed at the historically low levels.
Yeah.
And because this has happened, we're at a spot where our U.S. national debt compared to our GDP is at a ratio that it hasn't been since World War II. And kind of my caveman brain kind of thinks about this, silly, of it's kind of like our GDP is about $29 trillion a year, and our U.S. national debt is sitting over $38 trillion a year at this point.
And growing quickly.
Growing quickly, we're spending almost $1 trillion a month on it, just on interest. But anyway, so if I kind of look at it as if I make $29,000 a year in my job, but my Visa card has an outstanding balance of $38,000 on it. That Visa card is not getting paid anytime soon because I still got to feed my family, I still got to eat. And that's kind of, as a country, we still have these other obligations that we have to pay for, not just paying down our debt. So this isn't going away anytime soon. This isn't going away in our lifetime. There's been, historically, our comptroller of the United States of America back in the 90s and 2000s has also even said that we have to increase taxes in the future, and we have to increase them significantly. And so one of the things that we're doing as a retirement planning firm is we're understanding what is the impact to retirees. And that impact is significant. Let's say that you need $8,000 a month to live off of in retirement. We might have to take $10,000 out of your retirement accounts. Now, if taxes go up in the future, you're going to have a choice. The choice is maybe you take $11,000 out a month and run the risk of running out of money, but you get to keep your same lifestyle. Or you keep that same $10,000 withdrawal rate that you have, you just learn to live off of less. It's not a good place to be. It's not a good choice to make. And so what we want to do is we want to reposition you. We want to start planning for the future, knowing that that is a very big risk in your retirement plan. And so how do we take down the risk of your retirement? And we want to make your future more secure. And so what we do is we do tax planning. Tax planning is where we put the control back in your hands. We put the control back in your pocket. We don't use that legislative risk if taxes change in the future. We want it back in your hands of you get to make the choice on how much you spend in the future.
Yeah, the history tells us that things are going to change. RetirementTaxTool.com. Scan this QR code as we're talking about this. And you say this is the way that we've been told to do it, 401ks. Well, over the last 5 years, history will tell us that the government says, you know what, we're in such bad shape, we're actually going to give you something so that we can get some of our taxes now. 401ks now have moved into Roth 401ks. So I'm talking about people who are still working. Before we get to the conversion, let's get to contributions. And I talk to many people who say, you know what, after you talked about this, I just found out that I have a Roth 401k at work. Many companies aren't even telling their employees that they actually have another option. Can you give me the idea on what my strategy should be if I'm still working, if I should contribute to my traditional 401k, or if I should be contributing, if I have it, and asking my HR department if I've got a Roth 401k?
It's a great question. So the difference between traditional 401k and Roth 401k is that traditional 401k, you are putting the money in now and you're not paying the taxes on it until later. A Roth 401k, you're actually paying the taxes now. You put the money in, now it grows tax-free. When you take it out, it's tax-free. And once it's inherited, it's tax-free. And so one of the tools that you might have in your 401k plan is that Roth 401k. Now, if you put money into it now, you might see your paycheck go down a little bit because you're paying those taxes. I've had many people come in here recently. I actually just had somebody the other day that said, hey, Tom, I have changed my entire contribution in my 401k to Roth 401k. And I looked at it and I said, okay, so what's the purpose? Why? Well, I don't want to pay as many taxes in retirement. Cool. Let's move forward with that. So what we did is we put together the income plan. And for that individual, it actually didn't make sense that they should put money in their Roth 401k right now because they were going to be in a lower tax bracket in retirement. Versus I have a client of mine that's been a client for a long time that we've been trying to stack their Roth 401k in these final years prior to retirement, because what that's going to do for them is now that means that we don't have to do Roth conversions or as many Roth conversions in the future because all of their funds are going into the Roth 401k. We're aggressively invested, and that thing is shooting up like a rocket ship the past few years of growing their tax-free money for the future for them.
It's a beautiful thing when you use the rules for your advantage, because we know with legislative risk, the government can change the rules whenever they want. If you have an advantageous moment, don't you want somebody who can help you through that? That's why scanning this QR code is good and calling the number 833-348-4813 to put together a comprehensive written financial plan. We thought it made sense until we do the numbers, because yours aren't going to look like anyone else's, and they shouldn't. It should be individualized just for you. Hearing something that you're hearing for the first time and maybe could use some help or a second opinion, 833-348-4813. Make a call. We'll be right back.
Our entire vision for our growth at Retirement Wealth Design is to keep a personalized experience, to know every single person that we work with, but to bring into the fold other people that fit our culture, that care about the community, that care about the individuals, and that are the absolute best at their role that they can be. We want to make an impact in our community, and the first place that we start is making an impact in our team. So one of the things that we promote within our company is our own financial literacy and understanding. And then we try to promote that throughout the community. We want to be a pillar within our community. And I think that from a servant's heart perspective, our impact starts with us internally. And if we can serve our team is going to serve our clients, who are also going to serve our community.
So glad you are with us. Brad Johansson, Tom Elder, President of Retirement Wealth by Design. And a lot of you have been asking for this. I want to make sure that you have this option for yourself as well. This is Retirement Wealth by Design. It's the book that Tom put together. Everything that you would love to know about retirement and been afraid to ask or didn't know you were supposed to ask in this book. How do I get it? Funny you should ask. Scan the QR code that's on your screen. We will send it out to you for free. And then my guess is once you read all of this, you're going to say, I'm probably going to want some help. So we'll take you through that as well, because there are more rules than we can shake a stick at. What negative side effects can be triggered by making the wrong decisions regarding taxes?
Woo, that's a snowball question right there.
Yeah, we only have a few minutes left. I probably shouldn't have asked at this point.
This is one of those questions. So what are the negative side effects that can be triggered by doing some tax planning or Roth conversions? There's a boatload. And this is why bringing in a professional is a very good idea if you're considering Roth conversions. Because I've seen, unfortunately, the after effects of some of those consequences. And I want to be very clear. Roth conversions, they're about timing. They're not inherently good. They're not inherently bad. They're just about timing. I've seen good timing for Roth conversions that can save people hundreds of thousands of dollars in taxes, but I've also seen the wrong timing that can cost tens of thousands of dollars in taxes. And so it's more about timing than anything, because what ends up happening is you're going to have to pay the piper. Right? When you do a Roth conversion, when you move funds from a IRA to a Roth IRA, it will count as taxable income for the year. So it can have multiple ripple effects. We can see ripple effects with capital gains taxes. It can start driving your capital gains taxes up. We can see additional taxes when it comes to your Social Security. This is a big one, especially for those retirees that are collecting Social Security. Social Security is taxed on something called provisional income. And so sometimes what can happen is when you do this Roth conversion, you actually are essentially getting double taxed. You're paying taxes on the money that you're moving, and then more of your Social Security becomes taxable, and so you have to pay the income taxes on that. I just had somebody the other day that they are looking to move away from their current advisor, and that's because what had happened was they had gone in and they wanted to do some Roth conversions in their traditional IRA, and they did them 2 years ago. And what happened was that this individual did the Roth conversions 2 years ago, and they were unaware that that effect could actually have a ripple on their Medicare premiums, and their Medicare costs went up significantly this year. And unfortunately, they're going to have to pay higher Medicare costs this year. However, what we did is we were able to put them in a position to where we can still do Roth conversions, but we're going to keep them underneath of those. It's called IRMAA, I-R-M-A-A.
Nasty Aunt Irma.
Mean old Aunt Irma. I didn't have an Aunt Irma, so I can speak
She's
like
nasty. Yeah, that's the income-related monthly adjustment amount.
It is. And so the good thing, the good and bad is what you do this year income-wise is going to affect what your Medicare premium is going to be 2 years from now. However, what you do next year then will only affect 2 years from then. And so we'll get to reset it back to where it is a very manageable income amount. But there are all of these ripple effects that can happen, right? Whether it be even just driving up your income tax bracket. What we need to do is we need to measure it before it happens. I was always brought up, my dad taught me measure twice, cut once.
Yeah, you betcha.
Right? And so that's what we do with Roth too, is we measure twice and cut once. We don't want to make a mistake, because once you convert, there's not any going back, especially come the end of the year. So we need to measure twice. We need to measure what is this true cost going to be, whether it be income, Social Security, capital gains, Medicare. What's that true cost going to be? And then we measure that against what's the benefit going to be. How much is it going to save you long term? And we just go through the pros and cons together. I do the math, I present the pros and cons, and from that point you get to make the decision.
And doesn't this make much more sense? Just from hearing you talk, we hear a lot of advisors say, don't worry about this whole tax thing. You've got plenty of time to wait for it. And maybe in your mind you're saying, okay, well, I guess that must mean that before I get to 73. Remember, the government's going to change that as well before you get to 75 starting in 2033. The thing is, if you have a longer runway to work with the tools that you have, don't you want to take off to be great? Because if we get started, say at 55, before we start making the decisions at 65, that can then have a ripple effect to your 75 kind of thing. And if we're going to have 25, 30, 35 years in retirement, don't we want to start using the tools early because there are more at our disposal with time?
The only time better to start than yesterday is today. I will tell you, we have been doing heavy tax planning since 2017. That's when the TCJA, how the current tax code just went into effect. So we've been doing the heavy planning. However, don't look back, because with the one big beautiful bill that was passed, we kind of have this gift, so to speak, of the next 3 to 4 years at least that'll be in effect. So you have 3 to 4 years to get this plan in place. Start now, save yourself some money, and give me a call, 833-348-4813. Numbers at the bottom of the screen, and I'm happy to help any way that I can.
And he will, because that's what he's been doing. And you're looking for perspective, an expert who's done it hundreds, thousands of times to help you do it just once, the way you wanted to do it. 833-348-4833. We talk about how important your time is. We're grateful you've spent some with us. Now spend some time in the office. We'll be back here next time on Wealth by Design.